So that same old low level down here, and that high I just mentioned on the hourly chart and the low on the hourly chart is now been defined with a small little line segment. Okay, so we have a trend line here and a trend line here. That's the extent of a trend line. That's it. I only use them to highlight to my students. These levels are not on my chart. I'm watching a naked chart. Okay. You, while you're developing, you should have these levels drawn out on your chart because it helps you build and ingrain the idea that this is where liquidity is. It keeps you focused on that because it's easy to look at all these candles forming if you have the luxury of watching it in live, and you can lose sight of where you are. And once you lose your bearings, it's really confusing. And this helps you keep those bearings in mind. And what do I mean by that? Well, I mentioned how the market dropped down initially, and that takes the sell stops out. So sell side liquidity has been attacked. Traders are now tripped in going short if they sold on a break, trying to be a breakout artist. And then the algorithms go right back up to an area where it's been cleanly delivered relative equal highs. See how this high here, right before it dropped, is basically the same high here. Notice that? So retail traders see this and they trust it as what? Resistance. So the books always say, put your buy stop if you're going to go short right above a clear level of resistance. Well, these levels work for a short period of time, but majority of the time you see this event right here. And this is how I teach my students to go in here and look for those types of events, because what did I just tell you moments ago about looking for significant price moves? Before there's a significant price move of any real magnitude or importance, generally there's going to be a stop hunt that takes place right before that price delivery occurs. So what does it look like? You have relative equal highs, this high and this high. The market goes up when we're what? We're expecting lower prices on that weekly chart. We're on the last day of the week. It's already been heavy. It's weak. And the only thing it's been doing is consolidate. And the first thing it did was broke out to the downside, tripping what? Traders in a breakout to go short. So now they have traders caught on the wrong side, offside, and now they want to take the market up here, where those buy stops are going to be resting for those that were smart enough to sell short here or here and didn't get out below here. So the larger pool of liquidity is going to be resting here because it's in sync with the downtrend, and everybody that was short the day before, they seen this high form, and once it broke below this low here, they all rushed and trailed their stop loss right above that. And I understand if you're new and you think, well, this is easy to explain in hindsight, but I want to remind you, go back and look at the first slide I showed you. Those were actual entries. That's a live account through Thinkorswim. Charles Schwab, that was the clearing firm that did the brokers side of the business, okay? So I'm not showing you a demo account. I'm not showing you paper trading. Those were real entries, okay? They were real reversals, the whole business. But the main thing was I showed you that larger trade. This is going to be the framework that I'm teaching you how to find it, okay? But this pool of liquidity, once this occurs, you want to drop down to your lower time frames and start looking for something specific. And let's go into those lower time frames and find out what that is. Okay, here's a 2-minute chart. Why a 2-minute chart? Well, 2 minute, 1 minute, or 3 minute, or 5. 5 minutes still has a lot of room for imbalances to occur underneath that time frame. And what do I mean by that? The 1 minute, 2 minute, 3 minute chart tends to be the best for finding the imbalances for indices. Okay, don't take my word for that. Okay, if you're looking for high frequency setups intraday, the 1, 2, or 3 minute chart are just beautiful. They just offer a real good clarity. The reason why, because the high frequency trading algorithms are operating on nothing really higher than 3 minutes. But majority of the time, they're like seconds, okay? 15 second, 30 second, 45 second, 60 second intervals, okay? And what they're looking for are these small little imbalances. And what does that look like? Well, we have that run on the buy stops here, okay? Remember that old high here, the old high here, old high here. It runs right on through that. Once this occurs on that higher time frame, 15-minute time frame, you want to drop down to the lower time frames. And I'm using the 2-minute chart because this is exactly what I was using to find that imbalance and trade off of it, okay? The market creates a short-term low here, and then it breaks below that. This is key. This is called a break in market structure. Now, the foundations and underlying framework is we're in a market that's what? Weekly bearish. We're expecting that weekly candle to expand lower. It's been expanding all week. So we have momentum on our side. We have a consolidation that's occurred, and we had a pool of liquidity engineered with these relative equal highs, and the market broke out to the downside first, and then they ran on the highs. So once it went here, we don't rush in there and just go short because it went above the old highs. We're looking for some specific signature that tips its hand to you, okay? And I promise you, when you start going through your charts, and it's going to be homework for you, you're going to see this occurring almost every single day. And if it's not doing it this way, it's doing it the opposite direction as a buy, okay? Again, don't take my word for it. You're going to be flabbergasted, like that, flabbergasted, when you see how many times this thing forms every single week, okay? It's many times throughout the intraday charts it creates this type of move. But it runs the stops, then we have a short-term low, and then it breaks below it. So now we have a break in market structure, okay? Once this low is broken, you're gonna look for this little area here. That's that imbalance I mentioned in the beginning, right? So what's happening is the market's gonna go right up inside that area there, and that's where you wanna sell. Now, if you don't sell there, you can drop down to a lower time frame 1 minute chart. If this was a 3 minute chart, you can go down to a 1 minute chart and look for that to occur on that time frame as well. And it many times will form if you're looking at a lower time frame, like say this was a 5 minute chart, and you looked at a 1 minute chart, you'd find one down in here. It's a matter of scaling down in your time frames, because once you have an underlying premise to the market now likely to go lower, it becomes an easy thing to look for these types of things. So in your chart, once you're developing this idea and learning it, you're gonna highlight this candle's low, this candle's high, and this right here is what I teach my students as a fair value gap, okay? You don't have those in books, okay? You don't have any of that kind of stuff out there. It's something I introduced back in 2016, and obviously a lot of people discovered how good it is, and they try to make courses with it, but I'm gonna not touch that right here. But the idea is once it go up into that imbalance there, and once it does that, as soon as it enters that area, the algorithm that delivers price. Now, some of you may not know what that means, and some of you may not even agree with it. You may think that this is made up or it's contrived. I promise you, if you spend time with this, you're gonna quickly come to the conclusion that there absolutely is an algorithm, and it's manipulating the markets every single day, every single tick. It's completely controlled, okay, period. You're led to believe it's buying and selling pressure. Now, if I go back and use that analogy where it went down here first, then go up here, some of you may argue, see, that's the buying and selling pressure. No, it's not. It's liquidity. Now, you may argue and say, well, we're arguing semantics. No, I'm telling you what's going on. This is the logic. This is how these markets book, okay? Once you see these patterns over and over and over again, it's very easy to execute on them. But the impulse to want to do it the first time you see it because you've watched this video, that is going to be problematic for you. So you're going to have to do a certain number of weeks and months of back testing. There's no escaping that. You have to do it. Any skill set, any teacher, educator, system, whatever, okay, whatever they're going to give you, there's going to be some kind of growing period where you have to trial and error, fix the problems that you have about yourself. And I've literally taken your attention to a very specific framework and setup. Notice that? Some of you may think I'm still talking too much, but I'm taking you right into the heart of the matter. This is what it looks like. This is what you're looking for, okay? These are the fingerprints of that setup. These repeat. So if you know what they are and what those components are that make up this setup, you'll be able to find them. But focus on the imbalance after the market structure breaks. So this big candle here, it breaks down. Look at the next candle. It opens and trades higher and stops right there. So from this candle's low and this candle's high, when this candle starts trading, as soon as it opens and it runs right up into that, that's a short. You can go right in there and sell short. Be done. Now, where's your stop going to be? Well, you can put it above this high here, or you can put it above this candle's high. Whichever your risk parameters allow for. Okay, if you're trading the micro, which is, again, it's not a lot of money per tick, so the multiplier for that is very, very small. If you trade the larger full futures contract, and if it moves 100 points, and they can do it real quick, it can burn you pretty bad. So you may have the leverage to trade with a discount broker. Okay, you may have the initial margin to trade with a discount broker, but you may not have the wherewithal and the skill set to navigate this market. And that's the only thing I'm trying to provide here as an alternative, because there's a lot of individuals out there that will promote the idea that you can go out there with a discount broker and just clean up. Yeah, if you know what you're doing. But you don't need a discount broker to be profitable, okay? Looking at this further, we're gonna look at the logic in here. And I want you to think about, after this forms and you see that as your choice setup or entry, if it starts to move lower, you can still get in it. There's no reason not to think that you can't get in it here or in here. It's close to or in close proximity to where that area is as an entry. Once we take out a low though, once that occurs, then it becomes a matter of your chasing price. And if you try to get in, especially if you like use a market order, you may see it trade right to this low and say, okay, now I believe it's going to go down. You put a market order and sell short, and then slippage gets you down here. And it creates a larger area of risk that you have to assume. It's problematic. You want to learn to trust going short when the market's going higher, and that feels scary at first. But once you start seeing this pattern form, it becomes easy to trust it. And in fact, you want to be doing that. You want to be selling short, expecting lower prices right when the candle's going up. And retail traders can't grasp that many times. It's just like, it goes against the logic, because they think, I gotta have confirmation. All the books say I have to have confirmation. And that's somebody that's coming in late. That's someone that doesn't know how to read price. They can't really follow it. And usually they're the people that will trade short with additional sell stops. They'll put sell stops below the marketplace, and then that's the momentum entry for them. And it's kind of like a no-brainer. In fast markets, it works. But if you don't know what you're doing, and you try to do that in a market that's consolidating or about to reverse, it hands you your backside. Okay, so if you're looking at this framework here, and we've taken the buy stops, we have our entry pattern here, what would you be looking for as a downside objective? Well, I'm going to teach you the liquidity matrix. Okay, and sounds pretty cool, sounds neat and all that, but watch what it is. This here is your range. This is the low of the day, and this is the high of the day thus far. So if we take that range and split it from the low to the high to get the midpoint, all of this can be determined by a simple 50 level on a Fibonacci. So you drag your fib from this high down to that low or vice versa, and have your 50 level highlighted. Then anything above that 50 level, this is referred to from an algorithmic stance as a premium market. It means it's expensive. Now, markets can stay in a premium for a while and not go to a discount, which would be below the 50 point. Okay, 50%, anything down here is a discount. If you're bearish, if you're ever going short, you want to look at the previous range. Where are you at inside that range? So when this formed here, that little fair value gap, once that formed, you're thinking, okay, we are in a premium, so algorithms will want to go to a discount. That's the opposing side of the marketplace. So if it's going short here, it's driving the market lower. What does that mean? The algorithm is going to start pricing lower. You can have all the buyers in the world come in. If the algorithm is in a sell program and it's going lower, it does not matter. It's going to reprice lower and lower, lower. And then what will happen is those buyers that may come in with a huge influx of volume, they're going to get crushed and they get squeezed. You ever hear the term, oh, this is a bear squeeze, this is a bull squeeze? All that is an excuse for them not to know why the algorithm's doing what it's doing. That's it. That's all it is. It's an out. Okay? I'm telling you, this is what's really going on. So the market's moving from this premium high, this specific entry point, to a level below the 50 of this range, this low and this high. Now, I want you to, again, go back and rewind the video once we're done and look at that execution page where I showed you my entries going back and forth, up and down, and where I got out at, where I got in at, okay? I want you to think about what below this level here, the 50 level, what is resting below here? Sell stops. So now think about the idea of someone like you and I that would see this ideal entry as a short. We have to sell to get in that short. How do we get out of that short? We got to buy it back or cover it by buying. Well, we're going to find willing sellers at a low price relative to this point here. They're willing, already sitting down there with their sell stops right below that low. Now, look closely. What else resides right near that low? Do you see it? Pause the video before I show it to you, because it kind of ruins the experience, because if you find it and I don't tell it, it feels good. Right there is that imbalance I mentioned. Okay, it's only one single candle passing up, and the previous candle's high and the next candle's low. That area right there is an imbalance. From this area here, it went down below the 50 level and attacked these sell stops and completely closed in this imbalance. So every point of this candle's high to this candle's low, that range with the candle only going up, that's a buy side imbalance. It has to have an equal delivery to be efficiently priced and booked by the algorithm. It goes down and completely closes it back in with down movement. Notice the candle on this here, it opens and then trades down. So it fulfills its role of balancing the buy side offering, now the sell side offering. So that is an efficiently delivered price move. Precision elements from the entry here down to here. Everything else after that for the rest of the day, I didn't care about. Even though I had an objective of that old daily low, I wasn't expecting it to run into this particular day. And that's why I didn't participate anymore the rest of the day. In hindsight, I wish I would have left a small position on and just let it go, but you're gonna have that. You're never gonna be right about everything all the time, every single day. You're gonna leave things on the table. You're gonna get in too early. You're gonna hold too long. You're not gonna buy enough, or you're not gonna sell enough. There's always gonna be some reasons why you didn't do something right. So don't beat yourself up about it, okay? But if you can find elements like this repeating in the price action, can you agree with me that that is amazing precision? And this is the logic I used to do that trade. The very trade that I showed you, that was the largest one in the example of saying which one would you rather learn how to do. I basically just handed you an ATM machine, okay? This repeats every single week.